It is Wednesday, April 24th, 2019. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. This month, I'd like to highlight some of the key messages outlined in the material posted at the matasii.com site as part of our triannual update on the macro outlook. As such, I'd like to discuss the areas outlined here. The UK Telegraph writes, and I quote, "An industrial slump has been triggered by a perfect storm of factors, including China's slowdown, the car industry downturn, Brexit paralysis, and Donald Trump's attempt to upend the international trade system with tariffs on European and Chinese goods." End quotes. According to the Telegraph, the sudden loss in trade momentum is equivalent to the months after the dot-com bubble imploded in 2001, when trade volumes sank as much as 2.2%. Recent trade growth numbers are the biggest falls since the financial crisis of 2007-2008, when global trade plummeted, diving as much as 12.7%. Data from the CPB, Netherlands Bureau for Economic Policy Analysis, revealed that world trade volume dropped 1.8% in the 3 months to January compared to the preceding 3 months as a synchronized global downturn gained momentum. According to the IMF Managing Director Christine Lagarde, and again I quote, "This is a delicate moment for the global economy as many countries are in the midst of a severe slowdown. The global economy has lost further momentum in the last 6 months." End of quote. The global downturn in trade is widespread geographic, and Lagarde pinned trade volume deterioration on decelerating global growth and the impact of increased trade tensions on spending on produced goods. According to the IMF, the synchronized slowdown is expected to stabilize beyond 2020. However, in the meantime, it's likely the world could be headed for a trade recession, if not already in one, again according to the IMF. Lagarde went on to say further, more or less, the synchronized global slowdown has put developed and emerging economies into its most vulnerable spot since the financial crisis. These are pretty strong words from the IMF, who typically walk a very political road. We showed this WTO chart in our latest global risk update, but have appended an updated chart on the right from Nomura, showing the slowing is only getting worse. The economic indicators are confirming our macro outlook. One of the best macro cycle experts is the renowned Harry Dent. The following 2 charts are from his work. I interviewed Harry a couple of years ago, and I encourage you to review the podcast transcripts and charts from that discussion, as they are even more salient today as the window he warned about, I believe, is now arriving. The post-World War II era fostered not only a U.S. baby boom, but it similarly occurred in most developed nations. Most analysts recognize that the heavily indebted millennials are simply not going to offset the spending changes occurring as the baby boom generation moves into their 70s. Wall Street's professional investors are preparing for the worst, with 2/3 once again falling into the secular stagnation camp, ahead of what is now a consensus call for a recession in the second half of 2020. According to the latest monthly fund manager survey conducted by the Bank of America, which polled 239 investing professionals with assets under management of $664 billion in the April 5th to 11th period, investors are now positioned for secular stagnation. Even as they dip their toes into risky assets, they are long assets that outperform when growth and rates fall, like cash, emerging markets, and utilities, while short assets that require higher growth and rates such as equities and the Eurozone banks. There's no recession in their call right now. 70% of investors surveyed expect a global recession to start in the second half of 2020 or later. A whopping 86% believe the yield curve inversion does not signal an impending recession which begs the question, if everyone is discounting the yield curve as a signaling mechanism, why is everyone so convinced that a recession is coming? And tied to that, why is everyone so certain that yield curve inversion does not indicate a recession? About 67% of CFOs surveyed by the Duke University School of Business believe the nation's economy will enter a recession by the latter half of 2020, while close to 38% are predicting a recession by the first quarter. About 84% meanwhile believe the recession will have started by the first quarter of 2021, according to the study. What we need to fully recognize something that few talk about, and that is China's real economic data. The People's Bank of China deserves plaudits for delivering a softish landing, but a landing nevertheless it is. The economy will probably bottom out at a growth rate of about 4.5% this quarter on proxy measures. Such a stabilization is not enough for a world that has come to depend on China to hold up the heavens. The Greater China sphere of East Asia is in the midst of an industrial recession. Nomura forward-looking index still points to a deepening downturn. Those expecting a strong rebound in Asian export growth in coming months could be in for disappointment, especially when you consider that Chinese data is deliberately misleading. Xi Jinping had to beat expectations with a crowd pleaser in the first quarter. The number was duly produced, 6.4% GDP. Could it really be true? Of course it's not true. Japan's manufacturing exports to China fell 9.4% in March year-on-year. Singapore's shipments dropped 8.7% to China, 22% down from Indonesia, 27% down from Taiwan. Korea's exports are down 8.2%. It doesn't make any sense. A paper last month from the Brookings Institution called A Forensic Examination of China's National Accounts, which I studied, concluded that the GDP growth has been overstated by at least 1.7% a year on average since 2006. They use satellite data to track nightlights in manufacturing zones, railway cargo volumes, and so forth. They really got into the detail versus just a number that government puts on a sheet of paper and sends out. Bear in mind that if China's economy is a fifth or a quarter smaller than claimed, it implies that the total debt ratio is not 300% of GDP, but closer to 400%. If China's growth rate is 1.7% lower and falling every year, the country is less able to rely on nominal GDP expansion, whittling away the liabilities. Debt dynamics take an ugly turn, just at a time when the working age population is contracting by 2 million a year. The IMF says China needs growth, true growth, that is, of 5% to prevent a rising ratio of bad loans in the banking system. The thinking is that China will rescue Europe. Optimists are doubling down on another burst of global growth, clinched by the capitulation of the U.S. Federal Reserve. It will be a repeat of the post-2016 recovery cycle. I don't think so. Beijing has opened its fiscal floodgates to some degree over recent weeks. Broad credit grew by $430 billion in March alone. Business tax were cut another $300 billion. Bond issued by local governments was pulled forward for extra impact. But once you strip out the offsets, it's far from clear that the picture for 2019 has changed. Nor is it clear what can be achieved with more credit. The IMF said in its fiscal monitor recently that the country now needs 4.1 yuan of extra credit to generate 1 yuan of GDP growth, compared to 3.5 in 2015 and only 2.5 in 2009. The credit intensity ratio, as I'll call it, has worsened dramatically. I stick to my view that the U.S. will slump to stall speed before China recovers. Europe is on the thinnest of ice. It has a broken banking system. It is chronically incapable of generating its own internal growth or taking meaningful measures in self-defense. Momentum has fizzled out in all three blocks of the international system. We are entering the window of maximum vulnerability. As you can see here, the Chinese credit impulse has dramatically reversed. Although China has stimulated and there has been a credit impulse, it was noted in Bloomberg that the People's Bank of China will not flood the economy with excess liquidity. That can be most clearly seen in People's Bank of China's open market operations, where they have skipped OMOs for 18 consecutive sessions. Thus, from a net injection point of view, the People's Bank of China has withdrawn liquidity, meaning letting things like reverse repos, MLFs, etc. just expire. All the major central banks have now eased in some fashion or another. This has had a significant impact on the global financial markets. The question, however, is how long will this last? How long will the central banks keep easing before market fragility, unintended consequences, and third-party contagion does its damage? Or easy credit just stops working as lenders stop lending because borrowers are too risky with poor collateral, and borrowers stop borrowing because they have insufficient cash flows to maintain existing credit, and zombie debt rollovers are harder to get. Despite what we said earlier, China's CPI, Money Fund 2, M2, exports and aggregate financing have all turned higher off the lows. The cyclic upturn in China is something commodities were foreshadowing. A slew of better data out of China is now turning U.S. Treasury yields up. China is now controlling global rates. It is steadily taking the leadership mantle from the United States. This is an unintended consequence of what current monetary policies are pushing. Shifting gears to geoeconomic developments, there are 3 points we must emphasize. First is the destabilizing impact just discussed through monetary policies and what they're having on the macro outlook. The markets have become driven by central bank liquidity and no longer reflect fundamentals, true price discovery, nor the correct pricing of risk. We are effectively rotting the capital system from the middle. Think about the fact that Japan's central bank is quietly nationalizing its entire market. The Bank of Japan has gone from being a top 10 holder in 40% of Japanese stocks last March, which I thought was outrageous, to 50% just 1 year later. The Bank of Japan is now a top 10 shareholder in 50% of all Japanese companies. Bank of Japan now owns a stunning 75% of all Japanese ETFs. If that isn't nationalization, I don't know what is. As of March 2018, the Japanese central bank has become a major shareholder in nearly 40% of all listed companies. This, of course, in addition to Bank of Japan's trillions in Japanese government bond holdings, which at last check were over 100% of the GDP and 43% of all those outstanding. The Bank of Japan also became the top shareholder in 23 companies, including NITEC, Danuak, Omron, through its ETF holdings, but as of Q1, it was among the top 10 holders for 49.7% of all Tokyo listed enterprises. The second is de-dollarization. Our Thesis 2019 paper on de-dollarization laid out the serious risk of this accelerating direction, and it gets worse daily, as you can follow from our almost daily posts on new developments. The development of gold-backed digital currency is just one more sign that dollar dominance in global finance may end sooner than most expect, and we may be getting dangerously close to that point right now. Russia and China are buying gold and reducing their United States Treasury holdings. There are practical problems with using gold as a form of currency, including storage and transportation costs, but Russia is now solving these transactional hurdles by combining its gold position with distributed ledger or blockchain technology. Thirdly, we are concerned about the underpinnings of the European economy and its very fragile banking system. There are many potential tipping points facing the EU and their banking system. The most recent, which we posted, was the contagion from Turkey, destabilizing highly dependent banks throughout Europe, but especially in already troubled areas such as Spain, Italy, and the French banks. Turkey, it appears, is significantly misrepresenting their currency reserves, possibly by as much as 100%. Keep an eye on Europe as collateral damage from the Asian slowdown shows, because the EU just doesn't have the buffer to absorb the potential shock. At a higher level, the macro situation analysis suggests 3 major drivers. First, the shift from capitalism to creditism and the emergence of zombies and unicorns. In 2018, the number of zombie companies defined as companies with profits, that is EBIT, earnings before interest and taxes, less than interest payments, total 536, not far off the high seen during the global financial crisis, which was 626. At 536 corporations, the number of zombie companies in the world is 13% of its total. Ominous. Low interest rates and the ability of lower-rated companies to issue debt has led to a rise in the number of zombie companies, i.e. companies that are extremely indebted and are unable to stay on their feet without the current backdrop of historical low interest rates. Secondly, growing inequality and the rise of populism and socialist thinking is a major issue. Political partisanship has risen in near perfect correlation with wealth-income inequality, which it itself is the hallmark of a deeply systemic corruption, as the system is rigged to benefit the few at the expense of the many. There's a phrase that describes a socioeconomic system becoming a means for personal aggrandizement at the expense of civil society itself. Moral decay, that's what it's called. How else can we describe a system whose inputs and processes are so rigged that the output, in this case, is the vast majority of all income gains flowing to the top 0.1%? When a socioeconomic system institutionalizes the extra legal privileges of wealth and power, that is moral decay. When government only responds in ways that first serve the interest of entrenched insiders, that is moral decay. When the financial system is rigged to sluice income and wealth to the top wealth power pyramid while strip mining the productive class below by inflation and taxes, that's moral decay. The third driver is the end of the debt supercycle. We need to remember that the international economy operates in pulses christened by Kondratiev waves, as Nikolai Kondratiev, the Russian economist and statistician who first identified them. Decay waves, as they're called, consist of an expansionary upswing lasting normally 15 to 20 years, followed by a downswing of similar length. We are now in such a downswing that could last till the 2030s. The new downswing results from more than the 2008-9 financial crisis. There has been a wave of Chinese and Asian working class resistance to exploitation, which has eroded profits. In the West, paradoxically, the historic defeat of unions has flatlined wages. As a result, goods can be sold and therefore profits maintained only by bolstering consumption through easy personal debt. That makes the Western capitalist model unsustainable and prone to endemic bank failure. The banks and their tame accounting firms are busy covering up this chronic instability via wholesale fraud. As a result, we are now near the bottom of this K-wave. In conclusion, we need to remember we are in the midst of a shift from a unipolar to a multipolar world. We've laid this out numerous times. The liberal world order, which lasted from the end of World War II until today, is rapidly collapsing. The center of gravity is shifting from the west to the east, where China and India are experiencing explosive growth, and where revitalized Russia has restored its former stature as a credible global superpower. These developments, coupled with American imperial overreach and chronic economic stagnation, have severely hampered the U.S.'s ability to shape events or to successfully pursue its own strategic objectives. As Washington's grip on global affairs continues to loosen and more countries reject the Western development model, the current order will progressively weaken, clearing the way for a multipolar world badly in need of a new security architecture. Western elites who are unable to accept this new dynamic continue to issue frenzied statements expressing their fear of a future in which the United States no longer dictates global policy. Confrontation will only accelerate the pace of U.S. decline and the final collapse of the liberal world order and what this means to the global macro outlook. This is precisely in line with our Thesis 2018 paper, The New World Order, where we argue the world is shifting from a unipolar world controlled by U.S. policy to a multipolar world. Secondly, the world is increasingly becoming ungovernable. Inequality and its consequences of populism and a shift towards socialism is making the governance of many economies almost impossible and certainly chaotic. You need not look any further than U.S. politics over the last few years. Thirdly, escalating seriousness of geopolitical tensions. We are witnessing escalating seriousness of geopolitical tensions. This week's new threat Is Iran threatening to shut down the Straits of Hormuz because of U.S. sanctions on Iran no longer being waived to certain previously exempt countries? We believe global growth continued to decelerate through the first quarter of 2019. We expect the global economy to stabilize at low levels in the second quarter before more visible signs of economic improvements led by China become apparent in the second half of this year. Ultimately, we think a global recession this year is unlikely, and the policy easing underway in China is a material part of that projection. A recent shift in Fed policy should also reduce the risk of a recession. The central banks have moved very quickly from where it stood at the end of last year. While the Fed's pivot has not yet telegraphed a cut to the Fed funds rate, we think it's possible that it could lead down that path quickly if the U.S. growth weakens further, which we see happening. The nimble response from these two particular central banks should diminish the downside risk and clear the way for a more constructive outlook on financial assets as we end 2019. We've seen this view start to play out in the equity markets, but it's likely to extend to other markets as well, especially in the fixed income, corporate, and emerging market sectors. Within this context, we are constructive from both U.S. Treasuries and emerging market fixed income securities. We're talking just 2019. 2020 is a completely different story. So in closing, as I always remind you, remember the answer will be to print more money. It is the only answer politicians will ever agree on, until no one, that is, wants it or trusts that money. Invest accordingly. I'd like to take a moment as a reminder to not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2019 turn out to be an outstanding investment year for you and your family. I thank you sincerely for listening.